Hey, good afternoon, everyone. Thanks so much for giving me your time. This is Mark from Right Line Trading, and I'd like to show you what I think you're going to come to see is an extremely powerful trading system that very precisely tracks the flow of institutional money and really gives you stellar trades. I'm going to show you the performance of our live trading room month to date, and the results are just really stellar. So let me start with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers or for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures or forex markets, nor for any profits or losses that may be incurred. Participating in trading in the forex and futures market does involve substantial risk, and it should be understood that a person can lose substantial amounts of money. Therefore, participation in these markets is not appropriate for everyone. Careful consideration of your financial position to be made prior to trading. Never risk more than 2% of your account on any trade. Do your own due diligence. Right Line Trading is not a registered financial advisor, not a licensed commodity trading advisor. We recommend that you consult one. Now, I'm going to skip my own background and just go right into the first part, which is looking at order flow. Now, order flow is really part of advanced volume analytics. And what you're going to find, excuse me for 1 second, I'm really sorry. And what you're going to find is that most software analyzes order flow and volume analytics really in a way that does not give you really powerful ability to predict where price is going to move off the right edge of the chart. That's all that matters to us, is where is price going to go on the next candle. Let me give you an example of some of the problems we have and how we've solved them. Now, the first is the market delta. And the market delta looks at the bid-ask disparity at every incremental price level. Now, if you're trading futures, this is going to be at every tick level. If you're trading stocks, it's going to be at every cent level. And if you're trading Forex, it's going to be on the bid-ask, based on the disparity in lots. And what it does is it looks at traders sitting on the bid and the number of traders sitting on the ask and comes up with the difference. Now, if there are more traders looking to buy, then one would think now, this shows that the market delta of this candle is green. It's a little blurry. The number is 29.85. So one would believe that there's significant buying pressure associated with this candle. I'm sorry, all of a sudden everything happens during a webinar. Is that there's significant buying pressure associated with this candle, and the candle is going to close to the upside. The problem is that, and this occurs at every single tick level. There's more, it looks at the number of traders sitting on the bid, the number of traders sitting on the ask, i.e. the number of traders looking to buy, the number of traders looking to sell, and determines whether there's buying or selling pressure at any given level. If they're stacked sellers, you see this red square. If they're stacked buyers, you see this green square. The problem is that none of this has very much predictive value in determining the direction that price is going to go. Now, the overall calculation on any given candle on all the price levels is the market delta. Now, again, it's $29.85, it's green, it shows there are more traders sitting looking to buy, and one would think that you always get a positive candle on a positive delta. The problem is that you don't. And this is why a lot of these advanced volume analytical tools don't work. And this is the problem that has to be worked out before one can use this tool as a predictive value, as a predictive parameter to determine where price is going to move out into the future. The thing is, it has significant power. The problem is to figure out a way to harness it. Now, why would you get a positive delta and a down candle? And the answer to that is really kind of simple. Now, there are more traders sitting on the dome looking to buy than there are traders sitting on the dome looking to sell. The problem here is that you have aggressive sellers. If the price is 100, they may be willing to accept 99.8 or 99.7 in order to fill their order, or all the buyers are looking to take 100.1. So the buyers are simply looking for that one tick up to buy, but the sellers are willing to take an appreciable difference in order to sell. So they are very, very aggressive sellers. So if you look at a chart like this, which simply looks at the delta values of all the candles in a row and creates this absolute delta plot, which is what 99% of the software does, you're going to find out that on the right edge, it doesn't really give you any leg up as to where price is going to move out into the future. If the next candle has a huge positive delta and this goes up, it can still be associated with a down move. It's the same thing with these stacked buyers and stacked sellers inside the candle body. Although these are sequential tick values or cent values or pip values in which there are an abundance of traders looking to buy versus those looking to sell, we don't know how aggressive they are. And when the sellers are more aggressive than the buyers, even the stacked selling is not going to be enough for you to determine the direction that price is going to move. So in order to overcome this problem, what we've done is this. We look at the delta of each candle on the two higher time frames. Now, I trade Unorenco, so we look at the two higher multiple Unorenco charts. But it doesn't matter what you trade, whether you trade time, whether you trade tick, whether you trade range. If you trade time and you're trading a 3-minute, it's going to look at the 9-minute and the 27-minute. You're trading a 1-minute, it'll look at the 3-minute and the 9-minute. If you're trading a 377 tick, it's going to look at the two higher fib numbers, a 610, the next higher fib. You're trading a 5 range to look at the 8 range and the 13 range. The key is, it is not assessing the delta of the candles on your trading chart. It's assessing the delta of the candles on your two higher time frames. And that really is part of the power of the system. In addition, what we've determined is that one standard deviation's worth of data is accurate. The delta value the candle will close always in the direction of the delta, one standard deviation's worth of time. When you go out into the outliers, that's where you get those occasional aggressive buyers and aggressive sellers, and they turn those candles in the opposite direction of the delta. So what we need to do is throw out the outliers and keep the core data intact. So what we do on the 2 higher time frames is we put each of these market deltas into a 15-period simple moving average. This serves to throw out the outliers because you're looking at averaging the last 15 market deltas on the 2 higher time frames. And when both 15-period simple moving averages are sloping up, the bulls, it tells you the bulls are firmly in control. And our order flow assessment line is going to be green. And when both 15-period simple moving averages are sloping down, it tells you that the bears are firmly in control. And our order flow assessment line is going to be red. And when both 15-period SMAs are not in agreement, it's going to be yellow. Now, it is important for the indicator to tell you when both SMAs are in the same direction, so you have a direction to trade, as it is to tell you when to stand down so as to avoid taking a trade in chop. And that's one of the amazing things this week and this month, that we have been able to trade, essentially avoiding an enormous number of losers. Now, I ask a lot of traders in the trading room, what is their number one goal? What do they want to achieve in order to become a profitable trader? And if your answer is, what I want to do is I want to get a lot of winners, the answer is wrong. Because you're always going to get a lot of winners. If I put my teenage son in front of the trading platform and gave him 15 minutes of instruction, he could get winners. Your goal as a day trader or swing trader is to avoid losers. If you can do that, you can trade extremely profitably. And that's what this software allows you to do. It not only gets you into winners, like almost all software does, but it allows you to avoid an enormous number of losers. I'm going to show you that on a live chart right behind these slides very shortly. Now, we look at the market delta moving averages of the 2 higher time frames. I purposely left off the instrument and I purposely left off the time frames because this force that moves price is time independent and instrument independent. It doesn't matter whether you're trading stocks, futures, or Forex. It doesn't matter whether you're trading a 1 minute, a 1 hour, a 4 hour. It doesn't matter whether you're trading a 5 range or a 13 range or a 52 range. This force is going to determine where price is going to move off the right edge of the chart. Now, when both SMAs are green and heading up, they tell you that the bulls are firmly in control of the market and price is going to rise. Now, what's important to note is that price rising does not turn this line green. This line is being turned green by the SMA, by the 2 15-period simple moving averages on the higher time frame, on the 2 higher time frames. Price is rising because it's green. And you must trade in the direction of order flow or you're going to get stopped out. And you see this counter trend trader. He's taking a short trade where you give a group of sellers here and the price goes nowhere. You even have 4 candles coming down. Price is going to go nowhere. Now, there's a couple of other rules I'm going to add on that's going to keep you from taking this counter trend trade, even if order flow fails. But into the trend, and the trend is up, you must trade in the direction of order flow. Now, I don't recommend you try to trade a top or try to trade a bottom, and I'm going to talk a lot more about that in the next part of this discussion. But when the order flow line turns red, that's when you can take a potential counter trend trade, although I personally do not recommend it. If you can hang on 1 second, I really appreciate it. Here's another example. When the order flow line turns green, price is always going to rise. And when I say almost, I'd say 95% plus. You try to take a short trade on this green line, you're going to get stopped out because there's significant buying pressure here. Now, the only thing that can create this kind of scenario is when institutional money is involved in the trade. This can happen. Two commercial traders cannot create those 215 period SMAs sloping to the upside. So you're always going to trade in the direction of order flow. So you remove the risk of getting stopped out. Here's another example. The line goes green and price rises. Here, yellow, you don't trade. Line goes red, you must trade to the short side. Green, you must trade long. Now, this doesn't give you an entry. All it's giving you is an absolute direction that you have to trade. And now here's another example. When the line continually changes color, it helps you define chop. Now, one line, you're not going to know whether it's going to turn red and green, red, green, red, green, but on its own right now, if order flow isn't consistently bearish or consistently bullish, the price is going to chop. And then when the institutional money comes in and creates significant buying pressure to the upside, price is going to rise. All right, now I want to go to my other slide deck. I'm going to take this down. And this is going to be what we're going to be looking at for trading. But before we get to that, let me bring up the other deck. And what I want to do is talk about momentum. Now, George Lane created the first oscillator, and he did it back in 1957. Now, I want to move a little bit quickly because I want to have plenty of time to show you the entries on a live chart, and I also want to have plenty of time to answer questions. Now, momentum is the rate of change of speed. So what you're assessing here is if price is moving to the upside, if momentum is increasing, what it means is that price is accelerating to the upside. It's not just moving to the upside at a constant rate. If momentum is to the downside and the momentum line falls, it's because price is accelerating to the downside. Now, George Lane believed that because momentum was a second order derivation, it was the delta, it was the change in speed or velocity. It was a leading metric and told you how price was going to move out into the future. And he created the stochastic oscillator to foreshadow reversals, only to look for bullish and bearish divergence. He did not use this to track the trend. Now, back in 1957, when he created it, I believe that he was pretty much very, very accurate, because the market in 1957 is a lot different from the way the market is today. And I'm going to go into that also in a lot more detail. Now, I want to quickly talk about the formula by which oscillators are based on, at least all of them except the Laguerre. The stochastic oscillator, RSI, Williams percent K, are essentially all variations of stochastic. And the formula is really based on a very simple principle, and that is C is the most recent closing price, whether if you're looking at a candle or whatever formation. And it creates two values, a 14-period low and a 14-period high. So this is the average low over the previous 14 trading sessions or trading candles, and this is the average high over the previous 14 trading sessions or trading candles. Now, when C, or closing price, continues to approach the high of the move, momentum is increasing to the upside because price is accelerating to the upside. When the close of the candle continually approaches the low of this 14-period average low, then price is accelerating to the downside. And this acceleration to the downside or acceleration to the upside is what gives you the percent K line. And the percent D line is simply a 3-period moving average of percent K. Now, again, back in the day when George Lane was trading, and probably in the 70s and in the 80s, and maybe in the very early 90s, divergent signals were very accurate. And right now, if you try to trade divergence, you're going to get stopped out a significant amount of time. And I'm going to talk about the reason why. Now, what we're looking at right here is price accelerating up to its peak here. And it's right here. Price accelerates up to here, creating this much momentum. Then it retraces, but when it accelerates up to here, it accelerates with less velocity. It generates less momentum as price begins to rapidly increase up to the price again. It doesn't accelerate as much. So it creates less momentum. And you can see that price tried to accelerate up to this price a third time, created an equal amount of momentum, and then price collapsed. So that momentum really was a harbinger or foreshadowed a total collapse in price. When price rises and accelerates up to this high, creating a lot of momentum, and it accelerates up to this high with less momentum, then ultimately what would happen would be that price would collapse. Now, back in 1957, like I said, in the 60s and maybe the 70s and early 80s, this was a very accurate signal. And here's just another example of divergence. You get price accelerating up to here, creating this much momentum, then price retracing, and then accelerating up to here, higher, but on the same amount of momentum. So it accelerates to here and accelerates to here. So it accelerates to a higher price, but doesn't generate greater momentum. Accelerates at the same delta rate. And that is the harbinger or foreshadows a collapse in price. A higher price should accelerate up to that price faster. Now, back in the day also, the overbought, oversold signals were probably fairly accurate. You see this down arrow when the oscillator line crosses the 80 line to the downside, you get a sell, and it works. Oscillator line crosses the 20 line to the upside, and you get a buy. This is the percent K line, crosses the 20 line to the upside, you get a buy. Again, a buy. And here's a sell that goes nowhere, but here's a sell that catches a big move to the downside, and here's a buy as the percent K line crosses the 20 line to the upside, catching a huge move to the upside. But today, in this market, here's what happens. And that is that we know that a market can move to oversold or overbought and stay there for weeks or months, depending upon the time frame you're trading. Even if you're day trading, the NASDAQ or crude oil can move to oversold and stay oversold for hours. You can stay overbought for hours. Multiple divergent signals get run over. And the reason this is occurring is because this is a completely different kind of market. In this market, institutional money runs the market. And there is no mathematical derivation that's going to be able to tell you when the market has hit a high or hit a low, simply because the highs and the lows are created by the banks and the big institutional traders. And we can never tell when they're going to step aside on a move and let the buying pressure or selling pressure abate and have price come back. All we can do is trade in the direction of institutional money. That is what order flow allows us to do. Those two 15-period SMAs are not going to turn up or down together unless big money is involved in the trade and create significant selling pressure or significant selling pressure. Now our goal is to use momentum to track the same metric. Now, institutional money has created a really different kind of market environment. If we look at the market as a closed system, whatever intrinsic waveform or intrinsic wave pattern that was present is now completely skewed by institutional money. If there really was a five Elliott wave pattern, it's going to be obliterated by institutional money. If Gann theory really was operational at some point, it's going to be obliterated by institutional money. And probably the most important thing, and the thing that I see pressed on traders all the time, are platforms that teach you how to trade using Japanese candlestick formations. They are important, but 400 years ago, when they were created, they were predicated on the principle, essentially, that the power of each buyer was essentially equal to the power of each seller. That's what made an engulfing candle, a dark cloud cover, a doji, all of these patterns so powerful, because traders on the buy side and traders on the sell side were equal in power. This is no longer the case. If institutional money is buying, it's going to obliterate any previous Japanese candlestick signals to tell you whether to go long or go short. All we can do is try to track the footprint of big money as closely as we can and be right behind it, like 1 millimeter behind the footprint of big money. And in my humble opinion, that is the only way you can trade profitably. Now, in the era of institutional volume, this is how I believe you have to trade. There is no such thing as overbought or oversold. This is now a fallacy. Any mathematical derivation that created a top or a bottom, like an oscillator, is just not operational anymore because of big institutional money. Markets will reverse only at the whim of banks and institutions. Now, what still takes place is price is going to revert to the mean. If you're looking at a 50-period moving average, eventually price is going to retrace to that 15-period moving average. But it won't do it until institutional money steps aside. Now, it's going to snap back to the further that institutional money pulls price off of the mean. If it pulls it out 1 standard deviation, 2, 3, 4 standard deviations, it'll snap back to mean price with much more force. And that's what these counter trend traders are looking for. We're looking to get in on the reversal and that snap back to mean price. But we can never know when that's going to be, and you're going to see in every single move up, just an enormous number of counter trend moves get run over. And trading divergence is now tantamount to trading against institutional money or money flow. We can only trade in the direction of money flow. We can only trade in the direction of order flow, which is one of a part of the footprint of big money, and the other is momentum. Momentum, when done appropriately, accurately assesses buying and selling pressure. And the only oscillator that does that, completely ignoring any potential divergence signals, and with it, allowing you to follow the footprint of big money, is the Laguerre oscillator. It has a default gamma of 0.5. It has multiple filters, all of which we've modified, which changed the speed and stability of the percent K line. Now, I'm going to show you on a couple of slides how different the Laguerre behaves than all the other oscillators. It doesn't look for divergence. It is looking to track the direction of momentum, which we are using as a proxy for the direction of big institutional money. Now, here's an example. Right in this box. Now, we always do a multi-time frame analysis. You saw before we did a multi-time frame analysis of order flow. If your analysis is done off your chart only, it will not have the ability to look out into the future and tell you where price is going to go. So our analysis is done on a multi-time frame basis. Again, we look at the 2 higher time frames. Only in this case, momentum on our trading chart is also important. And right in here, this is a 3-minute where price just chops. You can see that the long-term Laguerre assessment of momentum is mostly yellow. And the chart Laguerre never comes in sync with the long-term Laguerre. Here, long-term momentum is green, which shows that institutional money is creating significant buying pressure. You see this arrow? This is when the Laguerre on our trading chart crosses the 20 line and prints. It tells you that price on our trading chart is now coming into sync with momentum, or momentum on our trading chart, with the longer term assessment of momentum. There's your entry. And you get buying pressure all the way through the move. There's your exit, because the Laguerre on your trading chart has crossed the 80 line back to the downside. We don't look to trade divergence. We look to trade a multi-time frame alignment of momentum. And it's a tremendously powerful tool for assessing the direction of institutional money. Only institutional money can lock our chart Laguerre above 80 and keep it there. Only institutional money can take the Laguerre on our two higher time frames, press them above 80, sometimes all the way to 100, and keep them there over time. And price during that period of time is almost always going to rise. Here's another example. Long-term Laguerre is yellow. No alignment in momentum. Doesn't matter what our trading chart's doing. Here is where the long-term Laguerre assessment of momentum is green. Our chart Laguerre right here crosses the 20 line up. You're in here, and you get buying pressure all the way through the 3 minute. Now, I don't have the instrument because the instrument is irrelevant. It could be a stock, it could be a future, it could be a Forex pair. It's irrelevant. So it doesn't make any difference what you're trading. It's a 3 minute whatever, and it's on 3 minute bars, obviously, but it doesn't make any difference what instrument you're looking at. Here is a beautiful alignment. Here's the long term and your trading chart. Lock short. There's your entry. You come down. If you're out on the reversal candle, you go right back in and down. There's the cross of the Laguerre across the 80 line in the direction of long term. Arrow, entry, and down we go. And we're trading in the direction of big money. Look at the Laguerre line. It is locked at 0. The only thing that can lock this down at 0 is tremendous selling pressure. You'll see it on the order flow assessment, and you're going to see it right here. Same thing. Get a move up. There's our pullback into dual green Laguerres and the move up. This is signifying tremendous buying pressure. Our chart Laguerre is plastered to the 100 line. And our two higher time frames are also moving to the upside. I mean, this line can't accelerate anymore to the upside because it's a bounded indicator. Only institutional money can do this. And when we get any retracement, we're going to take the move and continue to the upside with it. Now, here's a 30 minute. And there's the cross of our chart Laguerre into the direction of the long term. Now, I don't recommend taking a counter trend trade. I go long above the 50 and short below the 50. I go long when prices, when the 15's above the 50. I have certain trading rules I'll share with you in a minute. But this just shows you the power of institutional money and how, if you're going to call a reversal and call a bottom, wait till the multi-time frame assessment of momentum is green. The price on your chart Laguerre, or the percent K on your chart Laguerre, which is designated by the arrow, turns up, and order flow is green, and price is going to rise. Here's a 3-minute. Laguerre across the 80 line. Price entry. Tremendous selling pressure. The instrument is going to fall. There's your exit. Here's a 60-minute. Down. Laguerre across the 20 line. You're already into a multi-time frame short Laguerre. You already have this tremendous selling pressure on the higher time frames. Now, I just want to show this slide. Then I'm going to move to the live charts very quickly, and then I'm going to see if there are any questions. Now, remember, the Laguerre is meant to track the direction of institutional money, follow in its footprint, assess tremendous selling pressure, not to look for divergence, to have you trade in a counter trend direction. That's going to get you stopped out. Here is regular stochastic. It crosses the line, the percent K line crosses the signal line above the 20 line, giving you an exit. And you're going to get out of this trade and lose the trade and miss the majority of the trade. And that's just regular stochastic. RSI is never even going to get you into the trade. The Laguerre is going to put you in and keep you in for the entire trade. And here's your exit. As soon as the institutional money steps aside, momentum is going to soar back to the upside. Remember that regression to the mean is going to occur. It's going to take you out of the trade fast. So I'm going to close this up. And what I want to do is show you our trading chart. Now, we've got all the metrics combined. And let's just go to an area. Now, I have it set on crude. We had great crude trades today. And let me just give you an example of a terrific crude trade. You have a couple. There's your arrow. The long term, now the upper line is order flow. Now here's what I want to do. Order flow, and I don't want to run out of time here because I think I only have 4 minutes. Order flow is assessed in the candle halo. With the candle halo magenta, we already know that order flow is to the downside. When it's blue, we already know it's to the upside. So we can take order flow and remove it. We can remove the order flow line. And the chart's going to become very simple. We're going to make it transparent, and we're going to put it in the same as the input series. Now we have a much simpler chart. We're looking at Laguerre here, and we're looking at the candle halo to assess the multi-time frame direction of order flow. The Laguerre on our trading chart crosses below the 80 line right here. Order flow is aligned to the downside. Down you go. This is a counter trend, bunch of traders trying to take a long trade against the direction of order flow. We're going to go right back into the trade short. Here's another trade. It's a break of a pivot. Our trading chart Laguerre is heading down. The multi-time frame direction is short. We have order flow. We break the pivot, and down we go. And I could show you this over and over again. Now, we had this trade this morning on crude, right here at 9:33. This was a 51 tick trade we got. Both Laguerres are locked short. Order flow is aligned to the downside. You can see the magenta halo. Break of the pivot, and down we went 51 ticks on this trade. I can show you this on any instrument, on any time frame. I just don't have the time to do it. Right here, this was a tough call. This is another short trade. Order flow long-term Laguerre, our chart Laguerre is just beginning to squeak down. Here we have no long-term. We don't trade. Here's another trade. Break on the long-term with order flow. Break short. Counter trend trader. We love these counter trend traders because when we run them over, they help push the trade to the downside. It's great to leverage these 3 up candles. Now, what these traders are doing, taking this trade long, is beyond me. Now, our pivot indicator in 30 seconds creates an accurate pivot unlike most. Pivots are created off candle bodies, not candle wicks. A 2/3 candle body close below a pivot is what breaks it. It's an extremely powerful move when you break a pivot because you're stopping out all the traders. These are all buyers here, and it helps push the trade down in our direction. I want to just show you really quickly. Here's our NDT. Here's our account performance. Here we go. Here's currency. I'm going to generate. We're up $4,550 month to date. Here are our trades, every one of them. Our summary. We have a total of 87 trades for the whole month. 82.76% are winners. That's a stellar win percentage. I'd like to approach 85%, but on 2 contracts only, and we still have one more trading day left to get us to about $5,000 for the month. If you're trading a $5,000 account, you made 100% this month. And that is exactly what we do. This is the live trades we took in our live trading room. Now I'm going to take 30 seconds for questions. Let me just show you the offer before I forget to do that. And then I'm going to take 30 seconds for questions. And I don't want to overstep my time. Now, this is our offer. Whoops. The Laguerre order flow trading system. It's normally $19.99. We're giving it to you. It's a special, $6.99. It's a lifetime license. Free upgrades for life. We're always making it better. You get a month in the trading room with me. I mean, this month we're closing it on $5,000. I mean, if you're in this month, you would have paid for this indicator 5 times over. You get a 10-module educational training series, 450 YouTube videos, and the first 10 orders get the pivot indicator, which is very powerful and very unique, and get 2 months in the live trading room with me. I mean, we're looking to make $1,000 a week. That's our profit target after commissions, which we calculate on Friday at the end of every session. The offer expires Sunday on May 26th at midnight. Let me drop it and take 1 minute for questions. It works on NinjaTrader 7, NinjaTrader 8. I am over time. Hold on 1 second. I'll answer 2 questions. That's all I can do. Because everybody here has been very nice to me, and I don't want to overstay. You can trade anything that you like. Okay, I'm way too high here. I started at 145. Let me move over to there really quickly. It works for swing trades. It works on any time frame, Ref. Does not matter. On a $5,000 account, we're closing it on $5,000, Rick. It swing trades, it day trades. It does not make any difference. This is a time frame independent system. All right, listen, everyone, I really appreciate the time. I've run over. I really wish you the best, and hope you'll join us in the trading room. I'm trading the system with you, and let's make some money. So everyone have a really, really wonderful day, and again, thank you for giving me the time and allowing me to present today. Take care, and best of luck. Bye-bye.